I'm Taylor Riggs in San Francisco and for Emily Chang, and this is Bloomberg Technology. Coming up in the next hour, here's an earful. Silicon Valley is listening to your most intimate moments. We'll discuss the smart speaker craze and how vulnerable users are to their conversations being transcribed. Plus, the best in tech. Facebook and Google drop out of their top 10 best places to work list, but DocuSign makes the Glassdoor list. We'll talk to the CEO about what makes that company so unique. And a scathing report, prominent short seller Andrew Left of Citron slaps a $5 price target on Peloton. We'll hear from Left. But first, to our top story. Silicon Valley is listening to your most intimate moments. It is the focus of Bloomberg Businessweek's in-depth piece on how the smart speaker craze left users vulnerable to their conversations being transcribed. It was one of the most read stories on the terminal on Wednesday. And here with the story, including the devices and use of contractors to transcribe those intimate conversations, it is Bloomberg's Austin Carr from New York, Matt Day in Seattle, Sarah Fryer from San Francisco, and Garrett DeVink in New York. Austin, let me start with you. Contractors in your story seem to have a problem with this, while the management, though, at Big Tech didn't. Why?
That's correct. Yeah, we spoke to dozens and dozens of transcribers and contractors in this story from everywhere from Ireland to India. And they really had ethical quandaries with this service. They were eavesdropping essentially on a lot of Siri or Alexa customers in order to improve the system's speech recognition capabilities by transcribing our recordings that we submitted to the cloud. The really fascinating thing was that profound disparity that you mentioned. A lot of the contractors felt this was ethically dubious, whereas the Silicon Valley folks, executives, engineers, and so forth that we talked to really didn't think this was such an issue at all, despite years of privacy issues. They saw this as essentially a way of improving quality assurance. One executive at Apple even, who worked on Siri a few years back, described this as a way of simply fixing voice bugs. But the bigger question is whether or not they disclosed any of this to consumers. Did they have a sense that humans might be listening to the recordings at some point?
Austin, any sense that Big Tech takes this more seriously going forward?
Well, definitely. We've seen a lot more of the companies issuing new disclosures, new disclaimers, but particularly when it comes to companies like Facebook or Apple. Apple in particular says that they've had privacy at the center of as their core value. But this would seem to be an indication that they haven't quite woken up to the fact that users expect more privacy considerations and more data privacy when it comes to interacting with these devices.
Let's bring in now Bloomberg Technology's Matt Day to explain some of the security concerns that surround Amazon. Matt, what was interesting to me is that they gave the impression about privacy while not really actually getting it. Your take?
So Amazon, they were first out of the gate with smart speakers, and they realized that putting a microphone in people's homes was going to be a potentially controversial thing. So they engineered a couple of transparent measures they thought would give them kind of cover and trust from consumers. One of them is the spinning light on top of an Echo speaker, lets you know when the thing is recording. And the other was sort of the ability to go in and delete your audio recordings and view those through a web portal. And they leaned very hard on that kind of transparency. But at the same time, they weren't so upfront with the fact that they were sort of using user data as kind of a massive R&D lab to improve the service, right? To get new ideas for exactly what they were going to launch on Alexa and new features, and to sort of correct errors in the system as it stood.
And now I want to get to Facebook's latest. We're joined by Bloomberg Technology's Sarah Fryer. Sarah, what's interesting here is Facebook is a newer entrant into the market. Why the heck would they get into this market now?
Even after all of the controversy over these listening devices, Facebook still felt like it was very important to do the same with their data, their listening data, to try and improve it. And they really didn't think of it as very different from all the other things that they collect from their users. As you scroll Facebook, as you type, as you interact on the service, Facebook thinks that you understand that they are going to parse through everything you say and do and use it to make their systems smarter. The thing is, there's a difference between a machine doing that and human beings doing that. And especially with audio data, there's something so intimate about the way that this works behind the scenes. And if it was so natural and obvious to the companies, why did they feel it wasn't necessary to disclose it to consumers? Of course, consumers are alarmed.
Well, and Sarah, yeah, given everything else that's going on with the lack of trust in Facebook, any sense that customers are trusting Facebook with this device?
Well, they are purchasing it. There's a lot of compromises that we will make for our own convenience and entertainment. But I think that a lot of people are not aware about the network of contractors that are listening to this audio to do, as Matt explains, quality assurance testing and trying to improve the way the speech recognition works. And Facebook looks at this as an accessibility issue. They're trying to make sure that all different types of human voices can be recognized by their computers. The fact that they need humans to do this because the machines aren't ready yet, well, that just certainly wasn't part of the marketing.
And finally, I want to bring in Garrett DeVink, who covers Google for us. And Garrett, what's interesting, Google continues to use humans over some of the technology and some of the contractors instead of real employees. Does that help give them cover for all of this?
Yeah, I mean, I think Google is also using contractors, and I think that's a point that a couple of my colleagues have just raised. That I think for me, when I first started, learning about this, digging into the story, and reading the reporting of my colleagues and others, was that this was mostly being done by contractors. Right? These are not Google employees, not necessarily Amazon employees. In some cases they are, but mostly it's people who are employed by completely different companies, sometimes in countries very, very far away from the headquarters that these companies are based in and where they make their big decisions. And with Google, that really that sort of hit home earlier this summer when one contractor in the Netherlands walked out of one of his offices, taking with him a bunch of voice recordings, gave those over to some journalists who were able to listen to them and figure out who the actual humans were whose voices were being recorded, those consumers who weren't expecting that to be listened to. And sort of that started a bit of a scandal, and Google has said that they've actually paused human transcription of Google Assistant audio. But of course, they need to transcribe these transcriptions with humans to continue to improve the service, to make sure that it can understand people with different languages, different accents, different speech impediments around the world, just like my colleagues have said. And so they'll surely start doing that again sometime soon to keep up with their competitors.
Garrett, should we start to get a sense that they would use more technology versus human review, and should that give us any comfort that not actual humans could be listening in?
I think all these companies wish that they could use technology to do review, but the reality is, and this is sort of the story when it comes to artificial intelligence all over the place, is that it's still not quite good enough. You still need humans to double check that these things are learning, that they're improving. And for the time being, we're going to need humans. It's the same way with Tesla cars. There's going to be accidents. We're going to need human drivers in some of those self-driving cars, until we get to that point sometime in the future, not sure when, that the machine can actually fully take over on its own.
Bloomberg Technologies' Austin Carr, Matt Day, Sarah Fryer, and Garrett DeVink, thank you all for joining us. Now, an update on that T-Mobile Sprint $26.5 billion merger deal currently being challenged by 13 states and the District of Columbia in a New York City courtroom. A Sprint executive says that the wireless phone provider will not survive much longer without the T-Mobile takeover because it lacks the resources to upgrade its networks and has generally weak business prospects. Jay Bloom, he's the company's vice president of network development and engineering, testified that, quote, Sprint would not be viable within the next 2 years. The testimony rebutes claims that states made that Sprint has a viable plan B. Several states are suing the proposed tie-up due to antitrust concerns. That trial expected to last about 3 weeks. And coming up, we go through Glassdoor's list of best places to work, how cloud startup HubSpot earned the top spot, while big tech players like Facebook and Google slide from the top 10. That's next. And if you like Bloomberg News, check us out on the radio. You can listen on the Bloomberg app, Bloomberg.com, and in the U.S. on Sirius XM. This is Bloomberg. Apple is offering a number of eye-watering pricing options with its new Mac Pro desktop computer. You can buy the device for just under $6,000, but fully loaded, the Mac Pro will set you back about $52,000, and that doesn't include the $400 wheels for easily moving around the office. Now, big tech companies used to be seen as some of the world's most desirable workplaces, but now they appear to be losing some of their luster. Facebook and Google have dropped out of the top 10 best places to work in the U.S. That's according to Glassdoor's annual rankings. And this year's top 4, HubSpot, Bain & Company, DocuSign, and In-N-Out Burger. To discuss, we're joined by Glassdoor chief economist Andrew Chamberlain. Andrew, I think the big theme that struck all of us is big tech continuing to drop out. Why? What's going on?
Well, you have to remember, this is the 100 best places to work for. So even being on the list anywhere, even if you dropped, still a great place to work. But the big story with tech is that these big companies have big company problems today. So Facebook, of course, with political scrutiny, the Cambridge Analytica scandal, it's changing what it's like to work there. It's slowing things down and introducing more politics and bureaucracy. And we see the same types of comments at Google and some of the other big tech companies. They're now 10,000 person plus employers. They're not the small, fast-moving startups they used to be. And so that is starting to weigh down on culture.
Facebook in particular caught our eye because we talk about that company so much on this program, dropping 16 spots. Just 2 years ago, they were number 1.
Right.
Is it really just becoming a big company?
Well, it's partly that it's changed because of the political nature of some of the controversies. The motto of move fast and break things just really doesn't hold up in an era where your product can disrupt the U.S. election. And so it really does surface. We see those kinds of comments in the Glassdoor ratings. And the other thing to know about Facebook is that we look at all the different kinds of ratings, like we look at the work-life balance and pay, and one of the ratings that has really slipped there is senior leadership. People view some of the problems at Facebook as problems that are coming from the C-suite.
It was interesting to know, taking sort of a positive spin on all of this, that big tech still makes up the largest group. 31 companies make up that top 100 list.
That's right.
What was the general theme about why tech is such a large portion of the positivity?
Well, so we've done this list for 12 years in a row. This time we've done it, now it's for 9 different countries. Tech is always toward the top of the list. And it's because they've been in this intense competition for talent. Tech really invented the great workplace experience out of necessity. But today it's being copied by people more and more because they know that it works. So the common themes, it's simple. It's not ping pong tables and pay, and it's not free lunches. What it is it's career opportunities, so people feel like they can grow. It's having senior leaders that people believe in, and it's having a clear mission and vision so that it's not just a job, that it has some social impact as well as what their business is.
And I want to take some of what you said and look at the key themes that you all saw in the top 10, because that range, we mentioned In-N-Out Burger versus HubSpot. What collectively made up the top 10? Yeah,
the top 10 is a really diverse group, actually. There's only 3 tech companies on it. We had a government employer, Lawrence Livermore Lab. You have Ultimate Software, which is an HR tech cloud company. You also have In-N-Out Burger and Salmon's Financial and others. So what really binds them together? A lot of people are surprised to see In-N-Out. And what it is these are the best places to work from the perspective of employees themselves. When they think about all the other places that they could work in their industry. Like In-N-Out has great benefits. It has career opportunities for their people, and it has senior leaders who have a commitment to always serving fresh, never frozen food, and they're like a family. So basically, those are the things that unite all these companies. It's not necessarily pay, not an industry. Some of our winners are located in Utah, in Des Moines, Iowa. And not all of them are in San Francisco and New York.
And I want to talk about that because the number 1, HubSpot, notably located in Massachusetts. Yeah. How much of cost of living is now coming into this?
Well, this is definitely a factor. We see more and more tech companies locating outside the super expensive Silicon Valley area. Massachusetts, of course, not really a low cost of living area. Boston's quite expensive. They have their own version of Silicon Valley there. But the secret is they're drawing on talent from the big universities, and that's what they benefit from.
I want to end on one other company to help us lead into a transition to our next interview, which number 3, DocuSign. What stood out to you about DocuSign?
People at DocuSign really feel passionate about their product. When you tell someone you work at DocuSign, they say, "We love your product. It's great. It makes our life so simple." And also, people in reviews for DocuSign say that the culture comes from the top. that it's CEO and executive leadership driven. They care about employee experience. As I can tell you from my research, culture never comes from the bottom up. It always comes from the top down. And that's one of the main reasons why DocuSign ended up as number 3.
Wonderful. And we're all going to go back to In-N-Out because as an employee, I wonder if you get some of those free burgers. That was Andrew Chamberlain, Glassdoor Chief Economist. Thank you for joining us.
Thank you.
And coming up, we continue our conversation on Glassdoor's top employers of 2019 with DocuSign CEO Dan Springer after securing a spot in the top 3. That's next. And Bloomberg Technology is live streaming on Twitter. Check us out at Technology and be sure to follow our global breaking news network at Quick Take on Twitter. This is Bloomberg. Barclays Capital says ride-hailers Uber and Lyft are well positioned to make a profit. The team analyzed almost 2.5 billion trips in New York City, looking at how higher prices affect demand. They decided that the pair could charge more to make an operating profit with only a modest impact on ride volumes. Uber and Lyft shares have failed to take off since listing. Uber is down nearly 39%. Now, we just spoke about Glassdoor's annual list of the best places to work. And while we saw big tech names like Google and Facebook drop out of the top 10, we saw others rise to the top. DocuSign is one of those companies landing the number 3 spot. Here to discuss, DocuSign CEO Dan Springer. Dan, what makes your company stand out? Why would I want to come and work for you?
Well, I think our employees using Glassdoor as a great reference have spoken that there's a couple things we've gotten right. One is we've created an exciting vision, the DocuSign Agreement Cloud, to really go beyond that signature piece that most people know us for, to have a broader platform to build and be part of sort of the next big thing is one. Two is I think we, with our DocuSign Impact investment, have given people a reason to be proud of working at the company for our commitment to the community. DocuSign for Forests is the initiative we announced at the beginning of this year, with Jane Goodall at the World Economic Forum, to really try to be a positive role player in what's going on with global warming. And then the third piece is because people love our product, employees feel really good about working at DocuSign because they hear what we call the DocuLove, the stories from customers all the time. Those are the things that I think really make people excited.
We just heard from Andrew Chamberlain that culture starts from the top. What's your number 1 piece of advice in terms of the culture you're setting, the tone that you're setting?
Well, I think there's 2 things. One, I'd say go to a company that's already fabulous, like DocuSign, that has a fantastic culture. It makes your job a lot easier as a leader, and I did that. But in terms of the small part I've played to try to improve the culture, I think it's about inclusiveness and listening. And we do a lot to really understand what our employees want to make this the best place they've ever worked, or to do the work of their lives, as we say, and then try to deliver on those components.
I want to talk about the fundamentals of your company. Namely, you went public in about April of 2018. It's been a while now, but I hear a lot of CEOs in the latest months come out and say, thank God I went public when I did, because the environment today is so difficult if you're trying to become a public company. You happy that you went public when you did?
Yeah, I think I actually have somewhat a contrarian view. I think companies should go public when they're ready and not try to time to the market, because you want to make sure you have the right maturity, put the right systems and controls in place. We happen to be fortunate that I do think we went out at a time that some of the challenges today, and we didn't have to give a lot of thought. Do we want a direct listing? Do we want to do a traditional IPO, which is now on all the minds of all the folks that are considering going public. But I do think for us it was a good time, and some of the choppiness over last year, we got that behind us now, and we're able to, I think, grow very well going forward.
DocuSign isn't profitable just yet. Do you get a lot of pressure from investors to be profitable?
Well, we are profitable on a non-GAAP basis, and we have been for the last 8 quarters.
Looking at net income.
Net income, to your point, because of the stock charges, stock-based compensation charge. But I do think we get the investors now telling us growth is the number 1 imperative, and we're focused on doing that. I told you we're trying to build that DocuSign Agreement Cloud, the next big thing. We're going to focus on growth. But investors are saying they want responsible growth, and they want to see that path to profitability. And what we've shown them is with our high gross margin and the leverage we're getting in our business, that we're going to be a high growth, but also a profitable organization.
And I want to look at the rest of your stock price, frankly, because investors have rewarded that responsible growth. Your share price is still up about 150% or so since the IPO. The street, frankly, after the last earnings report, relatively happy. But I wonder if you can live up to all of those heightened expectations that you've set for fiscal 2021, like revenue growth, like billings growth. How do you live up to that?
Well, we have a lot of confidence, but I will tell you, to your point, if you think about the SaaS universe, we are at all-time high for multiples in this space. And I think they're warranted because of the high growth and the fact that those margin components we talked about, to your question about showing that profitability, people see something we haven't really seen in the tech industry for a long, long time, high growth and a path to profitability. So I think that they're warranted, but they are high, heady valuations. But we're confident with the power we have at DocuSign, we're going to be able to deliver on those expectations.
I want to see if you can pick one answer. I'm going to give you two options.
Yeah.
Going into 2021, would you prefer to upsell to existing clients or target new clients as you look at that revenue growth?
So, of course, I want both. But to answer your question, we're a customer success-oriented company. So while it's really important to me that we bring new people into DocuSign, I'm most focused that we're driving success. And those upsells that you're describing, those happen because we are driving success. If you look at our last quarter, we had 117% from our net revenue retention, which means our business just with our existing customers is growing 17%, even if we didn't bring any new customers on. And I think that's a powerful driver for us. So if I had to pick, I would take the customer success-driven growth.
You talked in the beginning of the interview about some agreements that you come to and pacts that you would come to with some other companies.
Yeah.
What more could we see from you in terms of engagements with other companies and securing more future agreements?
Yeah, so I think from a DocuSign standpoint, we've always been the partnership company. And it was interesting, before we went public, people thought it was so unusual that competitive companies like Microsoft and Google and SAP and Salesforce.com were all partners of ours. They were all investors in our company when we were a private company. So we continue to focus on partnerships. I think the place you'll see us do even more with partnerships are the other leading SaaS companies that haven't yet gone big with us. So that's like a ServiceNow or a Workday. I think those are the places you'll see our partnerships expand even more.
So finally here, there have been some rumors DocuSign could be the next acquisition target for a company like Salesforce, for example. Are you open to being acquired?
So I always say this, when you are a public company, you sort of give up the right to control your own destiny, and that's okay because you make that commitment to shareholders that you're going to maximize that value. I can tell you this, we do get calls. We don't comment on anything, rumors, of course, but I would love to continue to run this as an independent company. I'm having the time of my life. I don't think I'd ever find such a strong company. So as long as they'll let me, I'm going to continue to run it independently.
I'm going to let you get away with that answer for now. That was DocuSign CEO Dan Springer. Thank you for joining us.
Thank you for having me.
And coming up, Cisco takes on the chipmaker leaders. Can its new data center chip make a dent in the likes of Intel and Broadcom? That's next. This is Bloomberg. This is Bloomberg Technology Global Link, where we join Bloomberg Daybreak Australia to bring you the latest in global tech news. I'm Taylor Riggs in San Francisco with Sherry Ann in New York and Paul Allen in Sydney. Let's take a look at those top global tech stories of the day. Paul.
Thanks, Taylor. Amazon's bid to buy a minority stake in Deliveroo may get an extended look from UK regulators. The Competition and Markets Authority began looking at the $500 million investment in October, their reasoning being that the purchase could hurt competition by discouraging the American company from re-entering the British food delivery market on its own. Amazon has 5 days to offer remedies to the agency. And the Chinese company that owns TikTok is hoping for another viral app success. ByteDance is testing a new music app that is now available in India and Indonesia. Resso, which launched 6 months ago, has been installed by about 27,000 users, and what ByteDance hopes will eventually rival Spotify and Apple Music in countries where paid music services have yet to garner large audiences. And the managing partner of SoftBank's Vision Fund is stepping down. Praveen Akkaraju to explore working with early-stage startups in either an operational or an investment role. Akkaraju joined SoftBank in April 2018 and will be replaced by Deep Nisha, a senior managing partner at SoftBank. And those are the top global tech stories that we're watching. Taylor.
Thanks, Paul. And now networking giant Cisco has started supplying switch chips to major data center operators. The Cisco Silicon One is a semiconductor already being used by the likes of Microsoft and Facebook. Cisco claims that the chip is the fastest in the industry and is offering it to all customers, whether or not they use its network machines. Joining us to discuss it is Bloomberg's Ian King, who covers the chip sector. Ian, is this a new avenue of business for Cisco?
Yeah, I mean, it's a big move, really. They're basically adjusting to the way that the world of networking and semiconductors has moved. Once upon a time, if you wanted to build a computer network, the best, the fastest, it was difficult, so you went and bought a box from Cisco. Then along came Amazon, AWS, Facebook, Google. All of these companies developed their own skill set, and they said, well, we don't need these expensive boxes, we can do it ourselves. Cisco then really didn't have a play with these guys. Now it's saying, look, our components are fantastic, you can use these, go ahead, and it's offering them.
So what's the driver for Cisco? Is this a near-term sales goal, or is it more of a strategic long-term shift?
Yeah, well, I mean, normally, as I'm sure you're aware, when companies come out, they talk about, oh, well, this is a chip, it's coming next year, this is what we're going to do. I think part of the surprise today was, look, we're already supplying these things, they're already using them. So, answer to your question, both.
You know, you talk about Facebook and Microsoft already using some of the chips within the networking component. Are they looking to upsell to those existing clients or target potential new clients here?
Well, they're not really Cisco clients anymore. Less than 2%, according to one estimate we have, of Cisco's revenue comes from the so-called hyperscalers, the AWSs, the Facebooks. So really anything is better than that for Cisco. And these chips are not cheap, they're pretty high margin products. So if it can make a major inroads into their data centers, that's good news for Cisco.
When the industry is expecting less enterprise spending for 2020, will this shift help?
Yeah, I mean, it won't hurt. I mean, Cisco, as you're obviously referring to, has been suffering as having to take down some of its forecasting, behind what Wall Street was expecting, basically because, a lot of the big service providers, the Comcasts and companies like that, haven't been spending on their networks. And enterprise as well has been a little bit weak. So anything which offsets that, anything which is a way of going around that kind of dependency is good for Cisco.
Is there any potential pushback, given that this chip could put Cisco now in competition with some of their own suppliers?
Yeah, no, I mean, it's putting the cat amongst the pigeons. Everybody in this market has really been reliant upon Broadcom. Broadcom's the only what's called merchant silicon vendor, 80% market share. Supplies Cisco as well for some of Cisco's, lower end stuff. So they clearly will not enjoy this. This is much more competition coming into the market for them. And also Intel, which is also a Cisco supplier, they've just bet big on this market as well when they bought Barefoot Networks. Cisco's now saying, you know what, we're going to offer our stuff that's a rival to that as well.
So what other products did Cisco announce, and what can we expect in the product lineup that could help them in the coming year?
Yeah, I mean, a big router upgrade, 5G networks are going to need sort of what's called the back end, the data centers, to move a lot of that information around, and they're offering a new router for that particular use. And they also talked about fiber optics, which is not particularly exciting for most people, but basically transmitting data over fiber optic cables is kind of becoming a bottleneck. And what Cisco said is, we're going to put a lot of money into making sure that that doesn't become a bottleneck.
You talk about that new component for 5G. Who else should we be keeping our eye on as it comes to that competition as 5G heats up? Yeah,
well, I mean, Huawei has obviously been a huge supplier to that market outside the US. Clearly, one of the, the key stumbling blocks in the trade war has been the US government does not want Huawei in this country. So that competitive landscape is arguably a bit more fragmented than it has been for a long time.
Thank you to Bloomberg's Ian King. And plenty more global stories ahead. That's all next. This is Bloomberg. Shares of Peloton taking another hit, falling close to 10% since Tuesday. And this time around, it's not due to a widely criticized holiday commercial. This time, it's thanks to one of Wall Street's most active short sellers. Andrew Left of Citron Research put out a note saying that he sees, quote, clear flaws in Peloton's business model and predicts the stock will fall nearly 85% next year to $5 a share. Joining us now on the phone, it is Citron's Andrew Left. Andrew, in your note, you talk about enterprise value and enterprise value for subscribers. Walk me through your thesis on why you feel this company is overvalued on those metrics.
Well, on those metrics alone, so there's different ways you can look at it, and people have criticized that, saying, well, why don't we look at EBITDA per subscriber or customer acquisition cost? That's all very difficult because how they attribute some to hardware, some to software. But if you see a chart I put out, and it just shows how much the Wall Street is paying currently right now for every subscriber of Peloton. I compare it to Planet Fitness, to Match, Spotify, and you'll see right now the EV to subscriber is over $15,000 for Peloton. Versus, let's say, Match.com is $2,100.
Right. Well, and we're showing up that chart there, which, as you can see, on a per value per subscriber basis, it certainly does look overvalued. Except I want to break down that ratio a little bit, because if you increase subscribers, the denominator goes up, the ratio falls, and that's pretty much what people are buying this company on. If they're a growth company, a growth stock, people aren't buying it on current subscribers; they're arguably buying on future subscribers. What do you say to that?
I mean, it's not like, fair enough, but this business has already taken the low-hanging fruit. So we know who bought the first 500,000 bikes. The real problem is who's going to buy the next 500,000 bikes. The treadmill that they introduced was pretty much a flop. They're behind the curve with all the rest of the equipment. You see all the mirror technology right now coming out from their competitors. They're not there. It's an extremely competitive space. And most importantly, now with their digital offering, they're giving for $12.95. What other people, when you buy the bike, you have to pay $39.95. So you can, if you are value conscious, you could actually buy a bike for $700, let's say, and still enjoy the Peloton experience, the whole Peloton experience, and that's the Peloton Digital. And the CEO said some way that was their lead generation way of doing it. It seemed really sloppy. So you can enjoy Peloton and not have to pay over $2,000 for a bike.
Andrew, I wonder, are you short Peloton or short connected fitness as a whole here?
Oh, no, short Peloton. By the way, if Peloton, at $5 a share, if Peloton ends up to be $1.5 billion, $2 billion company, it's a major success. This is a spin bike, right? They didn't create the spin bike, and they didn't create streaming classes, none of that, right? And there's not a moat to any of that. So at a $2 billion company, it would be, hooray, huge. I don't know why Wall Street has to think this is a 9 or going to be a $10 billion company.
I do want to say that we have tried to repeatedly reach out to management and Peloton for requests for comment, and we have not heard back from them yet. Saying that, Andrew, would you buy Peloton if it were $5 a share?
No. I mean, it's like saying right now, would you have bought Fitbit or buy GoPro? It's just dead money. The best days right now are in the rearview mirror. If it was $5 a share, I'd take that back. I would buy to cover some of my short.
Okay.
But,
well, speaking.
No, but by the way, this is not a knock on the product. I think it's a wonderful product. It's just not a $9-10 billion product. This is going to wind up as a $1.5 billion company.
You said to cover some of your shorts, making a joke, I know, but I want to come and take a look at a serious chart that I'm showing here inside my terminal for Bloomberg viewers. And Andrew, to describe it for you, you know the story. It is the share price versus the short interest, which is now 66%. It's one of the companies that have IPO'd this year over $1 billion that are being the most shorted. Do you feel that your short trade could be a little bit overcrowded here?
I mean, if it's crowded, it's crowded. If it bounces on short covering, you just sell more. You always have to be properly allocated when you're a short seller. But, I mean, the thesis is I would never own a stock because it's a crowded short. There's nothing that they can do to turn this business around. I actually made a joke. Unless they create a bike that works out for you, maybe that would change it. But other than that, they're not going to be a $9 to $10 billion spin bike company in a year from now.
So, Andrew, you've talked about the bike and the treadmill, and I want to get some of the fundamentals back into the conversation here. Analysts at Baird, KeyBank, Oppenheimer, JMP really highlighted that lower priced terminal that could come out into the future. If they do a lower priced treadmill and you hit a mass market, how does that impact your position, given you could see perhaps this company hit a critical mass?
They won't. I mean, no doubt they're going to put out a lower price treadmill. They're going to do it either later this year or next year. They have not been direct about it because the more expensive one flopped. They have to because a treadmill is a much more popular piece of equipment than a bike. That's the only thing that's going to even keep this thing alive. Understand, for this stock to go from where it is right now, 30 to let's say 15, it doesn't have to fall off a cliff. It just shows decelerating growth. This is what you'll see. I was actually in a mall today, and the Peloton store was empty. It's not because people aren't buying Pelotons, but they've already picked that low-hanging fruit, and that has to be, this is not something for everyone. So, of course, they're going to put out a treadmill, and of course the treadmill is going to sell, but it's going to compete against all the other treadmills on the market. And similarly, I could also buy the Peloton digital experience for $12.95 with a $700 treadmill. And as consumers become more informed, it's going to be a battle for Peloton.
Does their announcement of introducing a rowing machine in 2020 change your thesis, given that's a new piece of hardware?
I mean, everyone has the rowing machine now. NordicTrack has the rowing machine. Their competition, Echelon, right behind them, has like 6 different SKUs. I don't know while Peloton was preparing for IPO, high-fiving, and introduced the $4,000 treadmill, their competition has completely, for digital home, health, and fitness, surpassed the offerings of Peloton. I think Tonal is Tonal, if you've seen that, super cool idea. Digital weights, unique, innovative, space-saving, again with the mirror. These are all technologies that Peloton has not taken advantage of. But there's nothing to say. Again, very important. People hear 5 and they see 30, you think stock prices, instead of thinking Peloton will end up $1.5 billion or $2 billion company. When you say it like that, it makes a lot more sense.
Okay, well, still a few $1 billion. That is Andrew Left of Citron Research. Thank you for joining us. Now, in its continued attempt to stay afloat, WeWork is looking to sell one of its recent acquisitions. Bloomberg has learned that the struggling office sharing startup is in talks to sell Managed by Q. Managed by Q, which WeWork has owned for about 8 months, offers technology to help companies manage workplace tasks and services. Here to tell us more is Bloomberg Technology's Ellen Hewitt, who's been covering the story. Managed by Q feels like it's a little bit part of their core business, helping workplaces, but they're trying to sell it off. Explain.
I think any company that's been acquired by WeWork in the last couple of years is looking to just kind of figure out how to protect themselves and knowing that WeWork is going to focus on its main business, even if you were an acquisition that was pretty close to the office sharing business. I think there's some concern that just you might not be WeWork's priority right now. And so what we've seen is actually the co-founder of Managed by Q, Dan Turan, is gathering a group to buy back his own company less than a year after he sold it to WeWork. I think it's just been such a tumultuous year for WeWork. He had come on as an executive at WeWork after the acquisition, and then he left the company, and now I think he's trying to, make sort of a soft landing for his own company and take it on going forward outside of WeWork. I think, especially for businesses that maybe were not as integrated in WeWork's portfolio as well. As you remember, they've also acquired companies such as an SEO company or, made investments in indoor surfing companies and things like that. I think if you are one of those companies, you're probably trying to think like, what's my future? And in this uncertain future, for even WeWork's core business, what's going to happen to us?
Well, and particularly after only 8 months when he sold it, now he's trying to get it back. From WeWork's perspective, does this feel like a little bit of a fire sale?
It's really unclear, and I think another question mark is how much this will actually help WeWork's bottom line. These Managed by Q was a pretty big acquisition, but some of the other acquisitions WeWork has made in the last year or two were not that big. It's not, compared to the billions of losses they've had in the couple last years, I don't think these sales are going to be making a huge difference. I think it's more of the company trying to focus on what they already do. Even when these acquisitions were happening and things were looking good, WeWork faced criticism for investing in businesses or buying businesses pretty far outside of their lane. So this may be more about focusing rather than actually recouping a lot of money from these sales.
And where is management in that transition back to the core business?
It's been a more slow last few weeks for WeWork news than in October and September, which were wild times. I think the main last piece of news that we've had is, the company did lay off around 2,500 workers a couple weeks ago, and that was something that, in general, what I've heard from sources is that went pretty smoothly. Many people knew it was coming, and the severance was pretty generous, 4 months of paid severance, and so a lot of employees, while they are, I think, disappointed to lose their jobs. For many of them, it's not like it was a sudden surprise, and it hasn't been seen as a very tough landing. But it is hard times for the company, and they are still trying to figure out management going forward. They are still maybe toying with a new CEO search and figuring things out.
Well, and you talked about that layoff, and you had a Republican Senator, Tom Cotton, say given those layoffs, he was hoping that Adam Neumann himself, not just WeWork, should be probed by the SEC, by the DOJ. Where are we in the midst of that SEC investigation? And then now perhaps new comments said he wants Adam Neumann specifically to be looked at.
We don't know much more than what we've already reported, which is just that inquiries are happening, but you are still seeing ire from not just, WeWork people who are now out of a job, but politicians, observers, industry observers, people saying something went wrong here and the company has to be accountable. And some people are also saying that Adam Neumann, as CEO or former CEO and co-founder, needs to be held responsible as well.
All the updates on WeWork. Thank you to Bloomberg's Ellen Hewitt. Now, still ahead, when biology meets technology, we'll talk to one of the scientists behind a breakthrough in contraception. It's the pill you only have to take once a month. Details next. This is Bloomberg. The Real was initiated with a buy rating at D.A. Davidson as the analyst said that the company's unique business model enables it to be the front runner for multiple trends favored by the millennial and Gen Z generations. He said the company is expected to dominate the digital consignment space, set a price target of $22 a share. GameStop shares plummeted on Wednesday after the video game retailer reported a third quarter loss that was much larger than expected. Most analysts were bearish on the results. Multiple firms lowered their price target, seeing no end to the industry-wide shift towards digital gaming that has repeatedly pressured the stock. And analysts at Oppenheimer raised their price target for Broadcom to $350 a share and maintained an outperform rating ahead of the quarterly earnings report on December 12. The analyst said he expects management to provide a fiscal year 2020 forecast and sees positive upside to revenue following the November 11th close of the Symantec acquisition. And those are a look at your top tech calls. Now, scientists say that they have developed a breakthrough contraceptive pill that only needs to be taken once a month. The star-shaped capsule could help reduce unintended pregnancies that arise from users forgetting to take their daily dose of the pill. We got unique insight from one of the study's co-authors, renowned biotech entrepreneur and MIT professor Robert Langer. He joined Janet Wu from Boston.
We designed a system that you can compress into a capsule, and then when the capsule gets into the stomach, the capsule itself dissolves. And then the system we compressed into the stomach opens up, but it opens up into a shape that's so big that it can't pass through what's called the pylorus. That's a little hole that connects the stomach to the rest of the gastrointestinal tract. So it's so big it can't pass through, but it's very, very open, so food can pass through it and everything. And then we put drug in it, and the drug keeps coming out. But what we did is we designed a part of it to basically dissolve in just about a month period. And when that happens, the whole thing goes out, and basically you deliver the drug for a month. We could actually make it go more or less.
When do you expect human trials?
Well, I don't know for sure. There's a company that we've been involved in getting started called Lindra, and I hope it will be in the next couple of years. They've already started human trials on other drugs using a system like this, but that's for a week.
You are closing in on 1,500 papers, 1,360 issued or pending patents. How do you keep up this pace?
Well, I have a lot of great people in our lab. I mean, one of the wonderful things about being at MIT is you have these incredible students and postdoctoral fellows and collaborators, and it's really them. And I feel very lucky that I've had such great people to work with over the years, and they're just very excited about doing work at the interface of biology and engineering, and so it's really they that do it. It's easy for me to keep up with it because they keep going over things with me.
Well, we have to talk about some of the companies who have helped found Alnylam, Momenta Pharmaceuticals, Moderna, hair care company Living Proof. I once read you never set out to become a founder.
That's true. My goal always is to see technology that we've been involved with get out to help people, get out to hopefully make the world a better place, make people have happier, healthier lives. But I was very naive when I started. We'd write papers, like you said, but people read papers and they'd use the papers, they'd cite them, but that doesn't lead to products necessarily. And so what I realized after a pretty long period of time is the only way that would happen is if I got involved in doing it myself. So I did. We patented different things, and then I worked with my students and others to try to start companies that could hopefully bring products to the world.
Of all of these innovations and companies you have helped create, what are you most proud of professionally?
Well, I guess, it depends how you look at it. The thing I'm always most proud of, which I kind of alluded to before, is my students. That they have, they've just had amazing careers. We've probably had close to 1,000 students and postdocs go through the lab. I think close to 400 are professors all over the world, including many in the Boston area, Harvard, MIT, BU, Northeastern, Tufts, and really all over. And they've just had amazing careers. I'm also proud of the fact that a lot of the things we've done have led to products that have affected, I guess according to some sources, billions of people.
That was Robert Langer, renowned MIT professor and biotech entrepreneur. And that does it for this edition of Bloomberg Technology. And Bloomberg Technology is live streaming on Twitter. Check us out at Technology and be sure to follow our global breaking news network at Quick Take on Twitter. This is Bloomberg.